welcome you watching this fresh and new edition of Market Masterclass on Money9, India's first multilingual platform for personal finance from TV9 News Network. I'm Sakshi Batra, and joining us on this show is somebody very special. I'm joined by market veteran Ambarish Baliga. Good afternoon, sir. Thank you so much for joining us on this special show, and welcome to Money9. It's your first show with us, and it's a pleasure to have you.
It's my pleasure to be there on your show, and thank you for
Thank
having
you
me.
so much for joining it, sir. Let me begin by first understanding from you what most of the investors and traders are right now worried about, that off and on we are seeing these bouts of volatile moves on the Indian markets. So what is really causing all of this, and is there a reason to get worried about it? How should investors approach this?
No, see, we've already seen the markets more than doubling in the last 1 year. Last March, around this time, people were actually getting panicky. We saw, the low on March 23rd last year. And after that, say around May, June onwards, the sort of a rally which we have had, I think most of the sectors, most of the stocks have become quite expensive. And at these levels, again, I doubt whether it can really move up much more from here because, like I said, most of the stocks have become expensive. But then the liquidity flow is there, which actually has been pushing it up. But then again, we should remember that liquidity is a friend of the trend. In the sense that the trend continues to be up, then the liquidity flows, and people, continue to make those profits. But once people start losing, and this is what I say, that in case the market corrects by 5 to 7%, that is when people may start panicking, because this is the first time they'll be seeing losses. The last 8 9 months they've really been making profits. Once they start seeing losses, there could be a bit of panic, and that exactly would actually reduce the liquidity flows to the market, and then you'll have again the vicious cycle coming back. So I think one should be a bit careful at this point of time. So what I've been telling, my investors is that you should at least take some money off the table. You made good money in the last so many months. Take some money off the table and wait on the sidelines for a while.
Right. And how are you looking at these macro concerns of oil prices rising continuously, the firming up of the US bond yields also, which are causing this kind of volatile move, even in the global markets? And should we be concerned about it? And where do you see both of these macros really going forward from here?
No, we should be concerned because one, the yields moving up will ensure that at least the FII money to an extent goes back. We have seen decently good FII flows in the last 3 4 months, and I think the rising yields could make part of that FII money go back. I think that's something which should be concerning because we've seen that in the past also. The oil prices going up again is another concern. Basically, because that will increase the input cost. It's just not oil. We've seen most of the commodities moving up, whether it's steel, copper, most of the metals have moved up, chemical prices have moved up. So, in the last 2 quarters, most of the companies have benefited from low inventory costs. The inventory which they're carrying, they have made decent profits on that. But now, going ahead with the raw material prices going up, I really don't know as to whether the sort of margins which we saw in the last 2 3 quarters would be repeated going ahead, and that could be one of the dampers for the market. So overall, with this inflationary pressure which is coming, may not be too good for the markets which have already run up. If the markets had not run up, then one could have said it's a different story altogether. But with the way the markets have run up, I think one needs to be a bit careful, especially with all these macro factors really going against you.
Absolutely. I wanted to understand, what would be most prudent for investors to do at this point in time? You did mention that they should actually take some money off the table. Right now, should they hold on to cash, or should they get into other assets, add on to other assets if the equity asset has gone up too high, or should they adopt a SIP strategy perhaps and get into those quality names that have still the potential to rise up high?
No, at this point of time, I would say just exit to an extent. You can never sell out 100% of a portfolio, nor will I ever advise anyone to sell out 100% of the portfolio. Stick on to some of the good blue chip names which you have, but the profits which you have made, like in the mid caps, I think it's time to book out to a large extent and hold on to cash. I don't think one should really be looking at other asset classes to invest in. Basically, if you look at gold, the gold prices have been coming down. It's corrected, I think, nearly 18% from the top. I think it can go down further. If you're talking of the bond investment, bond yields, have started moving up, which means even if you invest in bonds right now, you could lose out. So I think the best thing to do is to hold on to cash, maybe put on a FD. It may earn you 5%, but at least it's 100 plus 5. Because in the market, if you invest 100 today, for all you know, in the next 3 or 4 months, you may just get about 70 back. So it's better to possibly invest in a fixed deposit and wait for a while on the sidelines.
Okay, but you did mention about the mid cap, so I wanted to take that point forward and I wanted to understand, last 1 month we have seen the broader market space really outperform. So is that a space that will now start performing really well, and over the next course of 1 or 2 years, maybe the catching up that it needs to do with the benchmarks which have risen up quite much, when you compare it with the broader markets, will that happen now?
No, surely you'll have the mid caps giving you always better returns than the broader market. But then we should remember that in the last about 4 5 months, the mid caps also have done a lot of catch up, and the quality mid cap names have, have already given you good returns. Some have become multi baggers, and along with that, a lot of cats and dogs have started moving. So right now, what we have seen in the last couple of weeks is more of euphoria. So I think one needs to be a bit careful at this point of time not to try and cherry pick, because I don't think there are too many cherries left in the market at this point of time. But yes, if you're talking of longer term, wait for a good correction, and surely you should have quality mid caps when the market corrects.
To ask you about these specific sectors, what is your view on that? Of course, the banking sector has run up sharply, but over the last 1 week, we've also seen some bouts of underperformance. Even today, we've seen the, banking industry underperforming the markets, especially when you talk about the commodities cycle. That has really played out with the metals rising quite high. In fact, the metal index has run up about 150% from its March lows. So will that continue, or will the banks continue the rally? IT stocks have suddenly started moving up. Is that looking good at all? Next 1 year, if we talk about that long horizon, which is the sector that you think is going to be the leadership, will be the leader?
No, if you're talking the next 1 year, you could have IT outperforming to an extent. You could have FMCG, which hasn't really performed in the last 2 quarters. If you remember, FMCG was the first to really take off during the COVID season. The first 2 quarters it did really well, and after that, it has tapered off. I think FMCG is the other sector which should possibly do well going ahead. But then one should remember that when the market corrects, everything will correct. So this may not be the right time to really start investing fresh. Like I said, possibly there's a time to take some profits off the table. But when the market corrects, yes, I think you should look at investing in FMCG. You should look at investing in IT, pharma to a certain extent. I think these are the sectors to be looked at. And I think one dark horse for the year 2021 would really be travel and tourism. It would be more of tourism because that was the most battered sector. Now, I think with the summer vacations and post that the winter vacations,
Everybody's
I
like
think
dying to go out, I think.
absolutely, absolutely. I think people will come back with a vengeance as far as travel and vacations go. You look at places like Goa and the other tourist spots. Already, most of them are fully booked. Summer holidays is more or less fully booked. Winter holidays, people have just started booking as of now. So you can really imagine as to what can happen. This is again subject to the fact that we don't have huge number of COVID cases again starting back. We already seen that to an extent in Maharashtra and Kerala. I just hope it doesn't spread to the rest of
Yes.
the country.
That's true. That's absolutely true. And that is the worry point. We are just keeping our fingers crossed that this actually situation is mellowed down right here with the steps that the government is rightly taking. I wanted to ask you on the next big trigger for the markets. You did mention quite often in this discussion of ours that, right now is the time to take some money off the table. If you have made a lot of money, then pull some money out and hold on to cash as well. But the next big trigger for the markets, will it be the corporate earnings, and how should investors strategize for that then now?
I don't think the corporate earnings would be a positive trigger. I think it could be a negative trigger for all you know, because the last 2 quarters have been extremely good. In fact, they have surprised most of the analysts, and now the analysts and investor expectations have gone up. And like I said earlier, also because the raw material prices have moved up, maybe this quarter could be a damper for most of the sectors, and I think one should be very careful. And possibly, that could be one of the triggers for the markets to correct, as and when the results come out next month.
Okay, it's been a great pleasure speaking to you, sir. And thank you so much for sparing
Thank you.
your time for us and speaking to us about a whole lot of issues in the markets, especially with the kind of sectoral moves that we are seeing, the concerns that the markets have. And you've given a very strategic, advice to all the investors out there who were still thinking that this could be yet another opportunity for them to buy the dips, that they have to be now cautious with the markets having run up quite high and the valuations also topping the charts right now. One may need to just have a relook at the investments that one has and not continue with the greed factor for sure. So all of those things the investors definitely need to look at. Hold on to cash. That's the advice Mr. Baliga has given today. And take some money off the table. If you've made enough profits for you to cherish, then do that. And once the markets, with the impending correction, we don't know when it'll happen, but if it happens about 5 to 7%, then definitely there'll be opportunities for you to get into quality names. And he did mention the specific sectors also where you can definitely see some opportunities going on from here. With that, we wrap this edition of Market Masterclass. A lot more on the other side as well.